All right, welcome back to the Wealth Juice Podcast. As always, it's your boys, Corey and Ryan. Ryan couldn't do the intro. He just couldn't handle it. So I'm going to jump in and do the intro right here. We want to talk about real estate syndications today and give you a breakdown of like how real estate syndications actually work, because Ryan and I pivoted from buying single-family duplexes, triplexes by ourselves, where we own 50% each of these properties, to owning a smaller percentage, 10, 20, 30, 40, whatever percentage it is, of larger deals. So that's why we're buying 18 unit and a 10 unit and a 7 unit. You're hearing all this, but like I want to break down for you what the fundamentals of a real estate syndication is and how people who have been on the sidelines not being able to invest in real estate or not thinking they could invest in real estate for years, how they could actually get in. So that's what we're going to do on this breakdown here, and we're going to break down like the two main roles of real estate syndications. Before we do that, who does syndications work for? When people say real estate's passive, they're lying. But when I say that, I mean like if you're going out and you're buying duplexes and triplexes and you're trying to actively grow your investment portfolio, there's not a lot about it that's passive. Again, more passive than your 9-to-5 job, more passive than the active income if you have a property manager can be. But the only true passive way to invest in real estate is if you buy a part of a REIT, which you could argue you are investing in the asset class of real estate, but it's more like stock investing, or you're what's called a limited partner in a syndication. So if you make a high income, and you don't have to be an accredited investor always, because the deals that we buy, we do 506B, which is not always accredited investors. Some accredited investors can still invest in that, right? But which basically this is high W-2 income earners. Let's say you're an engineer, you're an accountant, you're a doctor, you're a lawyer, and you have a bunch of income, but not that much time. You don't have time to go research the market and try to figure out like what deals to go buy. You can be what's called a limited partner, and you can put $50,000 or $100,000 or $200,000 into a syndication and get all the benefits that you would get if you were investing in it yourself, but it's passive and you're on the side. The only thing that you don't have is control. And the control meaning like when do we sell, when do we refi? That's what the general partners have. So we're going to get into this. I don't know if you have anything to add on the intro there. I can go right into like the split between the GP and the LP and how that works.
No, that's good. Let's start with it.
Cool. So the general partners are what Ryan and I serve, and our partner Sean. We are the general partners we go and we source the deals, we find them, we underwrite them, we secure financing. Some of it's our own money, some of it's other people's money. We raise the capital, we oversee renovations, we oversee the property management, we manage the operations of the day-to-day, we refinance and sell the asset. We're the tools and the boots on the ground to what the partner in the real estate portfolio. A limited partner can be anybody really on the sidelines who's like, I'm just so busy. I got 3 kids. Me and my wife, or me and my husband, we're working full time, but I do have cash in the sidelines, and I love real estate. I love the asset class. I want the benefits of cash flow and appreciation and principal pay down and all the tax write-offs. You can be a limited partner, and you can put in your own hard-earned dollars. You can provide capital. You'll receive the returns, and you don't have any operational I guess you say responsibilities. So it is truly passive. Like you have a passive way to invest in real estate. So the thing here is that why do high income earners like this is that you don't need to go out and get another job. You don't need to like be a speculator and try to go learn about this, but you want the tax breaks, you want the cash flow, you want the efficiency, and you want exposure without operational burden. So that is why somebody who would be a limited partner comes in and invests with the general partners to go take down larger deals. Ryan and I have been buying. We bought a $2.5 million project. We bought a $2 million project. We bought 2 like around $1 million projects in the last couple of years. We don't have $500,000 sitting in a bank account ready to go buy these deals. So we're like, let's own a smaller percentage. Let's operate these deals, and let's bring in passive limited partners. And typically how we run these projects is that the limited partners actually own a higher percentage of the deal. We're in what's called a 70-30 split in a lot of these deals, and this is the structure of it, just for people that are trying to get the behind the scenes. The limited partners, you own 70% of these deals that we're buying, and the general partners own 30%. So me, Ryan, Sean, we will own 30% of the deal, and the limited partners own 70%. Now, obviously, if you bring $100,000 to the table, you don't own 70% of the deal, but you own your share and your percentage of the 70% of the deal. And in these deals, because the limited partners are bringing in the capital, we pay our limited partners, all syndications do and should, they get paid back first. So we don't make money until after our limited partners are making money. And that is, I think, the beauty of it, because our responsibility is to pay back our limited partners before we take profits. So that is kind of how the last 5 deals that we've bought have worked. And we really try to keep this tight knit. This isn't like you're listening to this podcast and you're like, oh, just anybody can come without a prior relationship with us and just invest in these deals. We create relationships through our podcast. We have Zoom meetings. We try to learn about our investors. We want to keep this like a small community of people that are going and taking down deals together. And that was part of the reason why we even started the Social One podcast in the first place. We didn't know that it would get to this point, but we want to help other people grow their money through real estate. Some people love it. I want to join the inner circle because I want to buy real estate. I want to go start and I want to own 100%. Great. There's a part in this plan for you for that. We can help you get there. But if you're sitting on the sidelines and you make $150,000 or you make $250,000 and you just haven't figured out how to do it, or maybe you are part in other syndications and you want exposure to some of the deals that we're doing in Vermont and New Hampshire, this is a great way to do it. So I wanted to explain the functionality of how the asset works and how syndications work. And we can break down examples if you want to go into that too.
Yeah, let's do it. Let's just talk about our buy box, why we invest in certain areas of the market, what types of properties we invest in, and then really I just want to like nail down you're only as good as your team, right? So for us, we have a strategic partnership with Greenbrier Capital and our partner Sean, and that's up in New England. And Corey and we've invested in a lot of different parts of the country, right? New Jersey, Philadelphia, up in the Pocono Mountains, Arizona, yep. And so, but over the last let's just call it 5 deals, and where we're going to continue to invest is in the New England region of the United States, right? And specifically Vermont and New Hampshire. They have one of the lowest vacancy rates right on the border. And I say Vermont and New Hampshire because the region that we invest in is in the Upper Valley, and it goes over the border occasionally.
Kind of like Philly and Jersey in a way. Because like investing in Philadelphia and investing in South Jersey, they're 15 minutes away. When we say we invest in Vermont and New Hampshire, I think people are like, they're big states. Like, what do you mean you invest in both of these states? Well, if you do some research on the area, it's called, did you say the Upper Valley?
Yes.
Okay, yeah, the Upper Valley, which is Dartmouth Health, Dartmouth College, they're like B+, A- areas. And we've said this on the podcast before, but there are towns that kind of overlap, like, that are right on that border there. Towns like Quechee, towns like Hartford, they're all, Vermont and New Hampshire sides. But we love the fact that we're trying to help provide better housing for this location because you said the vacancy rate's so low, and there's such a demand for housing. Like, we get applications every day because there's a lot of people that work in this tech bubble and the scene. Like, Oracle has a headquarters, not their headquarters, but a headquarters there. Strava has a headquarters there. I forget the company that makes Ozempic. But that company has a headquarters there. And there's a lot of like eds and meds that are around the area as well. So we've mentioned this on podcasts before, but that is like our buy box and why we buy there. And then, we can get into like who should invest, like who should think about doing this, if that's where we want to go next. I mean, we mentioned this, the people that have invested into syndications with us, they're police officers, they're doctors, they're executives, they're other business owners, they're sales professionals, they have a high W-2, and they can get the benefits of, a conservative rent growth strategy with us. They can get the benefits of the tax depreciation, and we're doing cost segregation studies on all of these properties because of the big, beautiful bill being able to put 100% bonus depreciation into, bringing that back and being able to offset a bunch of your tax liability. That's a major benefit for people that are coming in and want to, offset some of their income. So that right there is like the buy box, who should potentially do it. And then, we look at the syndication model as more of like, well, if you're thinking about getting involved in real estate investing, I think there's an opportunity for you to try both. Like, try going out and buying real estate and either managing it yourself or getting a property manager and buying the onesies and twosies, because you might love it. Like, you might really enjoy it. And we built our real estate portfolio on the side of our W-2 jobs for 5 or 6 years, and we were managing that. But I think it gets to a certain point in people's lives where they're like, do I want to have a potential more control and I guess you could say higher upside, but the amount of work that goes into it is just, it's significant. You know, it took me 18 months to save up for my first deal, and then 9 months after that, and then 6 months. So it gets lower, but it's just a lot of work. And anyone that wants to get into real estate thinking that like it's just going to be this passive rainbow road, like if you own the asset yourself, it's definitely not. But if you jump into syndications, it can be a lot more set it and forget it, similar to the stock market, but you get more of the benefits as well.
Yo, so if you've ever tried getting a mortgage, which I'm sure many of you have, you know how daunting and discouraging it can be of a process. The slow process, paperwork, being told no without any real explanation. One time we were even told that taking out a home equity line of credit on an investment property wasn't even possible. So that all changed when we were introduced to Neo Home Loans. What makes Neo different is literally how they approach lending. They're not just checking the boxes. They're legit problem solvers. They look at your entire financial picture and explore multiple angles, literally until they find a strategy that works. They helped us reposition our portfolio, pull out lines of credits to scale, and structure everything for long-term growth. And on top of that, their rates were some of the most competitive that we've seen. They just literally did whatever it takes to find a solution. For us, Neo has become our liability advisor. The same way you have a financial advisor on the asset side for the liabilities. If you're serious about building wealth through real estate, it's worth sitting down with them and getting your lending strategy dialed in. If you want to book a call with them, click the link in our show notes. Their team is unreal, but don't just take it from us. Find out for yourself.
No, I couldn't agree more. I think let's talk a little bit more about the Upper Valley. And
Yeah.
I know we mentioned Dartmouth Health and Dartmouth College. And like, so just kind of our strategy and what we look for in specific properties. Like Corey and I specialize in 5 to 50 units, like small multifamily. And we're looking for properties that are undermanaged or like poorly managed or undervalued. So we can go in and create appreciation and force appreciation. One of the projects we did was an 18 unit in Manchester, New Hampshire, and it's right in the main strip, right next to Southern New Hampshire University. And there was, it's probably like a C plus asset class, but we went in, the property was poorly managed, but then also it wasn't renovated. So we went in, put a brand new lighting package in, painted the walls, new fixtures, new flooring, like revitalized this place. And like slowly over time, you had to weed out the bad tenants and then put in better tenants or more stable tenants over time, right? And so it's just a full-fledged business plan going in and revitalizing a property and a project to make it new, beautiful, and target a specific tenant class. And that specific property, we target all Section 8 housing, right? A housing voucher. So the government is essentially helping people live in the property. And so for us, that is just the one specific business plan that we've done in one region of the area.
Yeah. That is a C plus. We typically try to go after like B plus, and the 10 unit is actually like A minus in a strip in an area where you're walking to restaurants and bars. So our business model has been focused on the Upper Valley, but the asset classes have been not always the exact one that we want, but the C plus is like a rental grade, or the B plus we're able to really like force appreciate the property and get a lot higher rents. So one of the other reasons that we mentioned that we love the Upper Valley is that the average median household income in the United States is like $82,000 roughly. That's not the median income, that's household. So if people are working, both spouses are working. In the Upper Valley, it's like $94,000. So that's above the median, which is a couple things. Like people are working professionals and they're working, I guess you could say white collar jobs, not always white collar, but just like jobs that are in high demand, and the tenant base is a lot better. So we mentioned Dartmouth Health, the tech ecosystem, but I don't know if we talked about this if we said it earlier in the show. I'm like blacking out a little bit, but 10,000 rental units are needed in this area over the next X amount of years. 10,000, and they're so far behind. Like, so, if you're on the sidelines and you're thinking like, okay, well, that's not good. It's like, well, we're trying to help improve that in a way by some of the properties we're adding units, where we've taken this 7 unit and we're turning it into an 8 unit because we're turning 2 commercial units into residential, and then there's a garage next door, and we're potentially going to convert that. Hasn't been confirmed, but potentially convert the garage unit either into better storage space or another residential unit. So adding units and trying to like this vacancy rate, it's not necessarily a good thing long term. So it's a tight rental market. It's stable, high quality tenant base. There's a constrained supply, and that's the employer-backed demand. Those are all things that make sense for people that don't live there to think, oh, I could potentially invest here. Because there's only a couple people that invest with us that are actually in the New England area. A lot of people don't live there. They live in maybe near us in Philly or live in California, and they're thinking, why would I go invest there? You don't hear about the Upper Valley really ever. You don't really hear about people investing in New Hampshire, Vermont that much because everyone's so obsessed with the Sun Belt. Everyone's so obsessed with Texas and Florida and other areas. So I think that's a differentiating factor for us, and that's why we like it.
Yeah, people just talk about the other markets because those are what are sticky on social media, and they, like people like the sexy things going out. Like a lot of operators, have their own thing going, and they just pick a market. And like I said, you're only as good as your team, and like our team is in the Upper Valley because that's where they were born and raised, and that's where all their contacts are, and which is awesome. If you can invest in your backyard, not that I don't recommend investing remotely if you're buying your first rental property, right? Because sometimes if you live in California, you can't afford to invest in California, right? But for example, like the properties we have up in the Upper Valley are all in this congregated spot where we picked this specific region, not only because that's where our team is, but we have relationships with Dartmouth Health and Dartmouth College. And with that, we have a relationship with the HR people there, so that way people that are in need of housing, we can put them in our properties. And so we've targeted some of our business plans for specific properties. I'll go into one of them that we have in Quechee, Vermont, which is a 10 unit, and it's a 6 unit on one side of the street, and then a 4 unit on the other side of the street. And we kind of talked about this briefly, but this is an A-class property, and we want to put in A-class tenants. So what we'll do is we'll pull grad students from Dartmouth College, or we'll pull nurses from Dartmouth Health, and they get a stipend. And with that stipend, they can afford a high cost of living, but they want a really nice spot. So then we will feed them into our Quechee, Vermont 10 unit. And what I'm saying here is like the relationships we have here, we have like no turnover, rarely ever, because of the high vacancy rate and people needing housing and good quality housing. So our goal here, that's just another business plan that we've had. And so what I mean by this is like the area that we buy is very centralized, but some projects will take on different business plans. I already mentioned like Section 8 for one, A-class for another. And then really sometimes it's just like the B+ working class. The good news for us is that there's a continued need for housing, so we can serve a few different demographics, but our upper hand in the Upper Valley is basically just our competitive advantage is having these relationships but also having these large institutions close by, so we can have the people that are working there and spending most of their time there have a good, healthy place to live in one of our properties. And our goal over the next, let's just call it next decade, it should be a little bit less than this, is to build a portfolio of 500 units up in the Upper Valley and eventually take property management in-house and just have this thing running full-fledged, as our own without having any property management. And we're going to get there. It's been great so far. And obviously there's ups and downs in any portfolio, but the tried and true winners of our portfolio have been in the Upper Valley, and that's why you've kind of heard in our previous episodes, like Corey and I have had a shift in the last like 2 years. Instead of the onesie twosies that we call them, like the single families, the duplexes we're buying 50-50, our higher upside is to not only help ourselves, but help out our friends and family members that want to get into real estate and they don't have the time, energy, or effort to do this. And we're lowering their risk by coming in with us on the deals that we've seen are tried and true. And for us, we're not reinventing the wheel with these. These are like very much cookie cutter deals, and sometimes they don't sound as sexy. And that's why I'm such a believer in them. It's like I like to know that I'm putting the same tenant class into the same type of properties, and we're continuing to churn and burn, even if it is a smaller property. Like the last 2 deals we had, I mentioned the 18 unit, which was like the 4th deal that we did, but then we had a 10 unit from there. Then we did an 8. And then we did a 7 unit. So like some of them are smaller, but to that point, it's easier to operate. We can throw them in with the same property manager that we have. And finding the deals too, like people are always asking us, like, how do you find deals? How do you underwrite these deals? It's complex to underwrite them. We have a gentleman, Tucker, on our team who's an engineer, and he's like a wizard in Excel. And we do a lot of cross analysis with him. And in terms of finding the deals, it's all through relationships. And that's one of the things I wanted to hit on with everybody. They're like, well, I'll never be able to find these deals. There's nothing on the MLS. Like there's another website called LoopNet where you can find deals too. But for us, we learned this earlier, and we were listening to podcasts. We're always hearing the people that are building these massive portfolios and seeing a lot of success in real estate. They're like, most of my deals are through relationships. And we're like, how are we ever going to get there? And it's just so interesting where it evolves as you evolve. And like we've created new contacts and built new relationships. And our portfolio up in the Upper Valley has all come through referrals. And what I mean by that is our property manager knew we were looking to expand our portfolio, right? We're telling him we wanted to build a portfolio of 500 units in the area. He has relationships with older operators that are coming to the end of their life cycle in the game, and they're looking to offset some of their portfolio. So I know one of the deals we got, I can't remember the exact deal it was, but one of the deals was a referral from the property manager. We took that down. Another one was from our lender. Then another one was, funny enough, from one of our friends that lives up in a property, one of the 7 units, found out the owner was selling, connected with Sean. We all got on a call and kind of vetted that out, built out numbers, and ended up landing on a deal. And we ended up buying that property, and the friend's still living there. So it's really cool. It's all relationship built these days, and I think that's where you're seeing some of the upside in some of these properties where it might not be smack dab in your face on the MLS.
Hey, let me pause the episode real quick. Let me know if this sounds like you. You're making 6 figures, you're climbing the corporate ladder, investing in your 401k and your Roth IRA, and maybe even a brokerage account. But deep down, you're asking yourself, is this really it? Like, am I just going to do this thing for the next 30 years and hope to retire in my 60s? That was exactly us just a few years back. We were curious and excited about real estate, but overwhelmed and without a roadmap. If you fast forward to today, we've built a portfolio of over 80 cash flowing units and grown our net worth to over $2 million. We made it our mission to help busy professionals like you take that same leap and start building generational wealth for yourself and your family. That's exactly why we created the Wealth Juice Inner Circle, a private real estate investing community designed to help you get your first rental property under your belt in as little as 90 days. Inside, you'll get direct access to us, our full investing network, private off-market deals, and our exact playbook, and a community of investors who are closing deals every single week. That first property changed everything for us. We always talk about it. It was the true foundation for building generational wealth. And honestly, if we had access to something like this when we first started, we'd be 10 times further along by now. So if this sounds just like you, click the link in our show notes and schedule a call with me. Yes, me. I'll be taking the calls. We'll go over your goals, map out a plan, and get you ready to close your first deal. Let's get it.
Yeah, I think that as we kind of wind down the episode, I wanted to give people an idea, which we have talked about the portfolio and the architecture of it and where we're buying. But to give people an idea, if you're coming back to this episode, maybe you're not listening to it right when we release it, but if you're an investor and you're like, well, what kind of returns would this even yield me as a potential LP? Keep in mind, these are not guaranteed, right? And this is an example. So, we cannot guarantee any returns. You invest at your own risk, but this is like what the projections are showing with these properties. So if you invested $100,000 as a limited partner on some of these deals, we have a projected 16 to 18% annual rate of return, or internal rate of return, excuse me. And the projected multiple on this property, for example, the 10 unit is a 2.1, 2.2x multiple. And our hold period is 5 to 7 years. So as a limited partner, if you came in with $50,000 or $100,000, you could expect to just over double your money in our hold period. Now, the goal is to refinance as fast as we can. And we bought some properties in 2021 and 2022 that we weren't able to refi in 2023 and 2024 when the renovations were done. Couldn't do it because we bought at 4% interest rates and then interest rates shot up. So keep in mind, this is very reflective of how the market is when we finish renovations, and that's just real estate investing. So our goal is to finish renovations in 12 to 18 months and then refi as soon as we can and get investor capital back. But if we can't do that, it's always refi, get investor capital back, and then those investors stay in the deal. They're not refinanced out of the deal. They're refinanced, get their investor capital back, and then they stay in the deal with us as we continue to hold it until we feel that is the appropriate time to get a high bid or something that we would sell it. So it's typically that 5 to 7 year period, and our goal is to over 2x your money in that hold period. So that, again, projections, not guarantees, but this is what we're optimizing for. So if you're sitting there thinking, man, I really want to put my money to work and try to double my money in this time frame, this is how we're viewing it and this is how it's happening. And the cash flow that comes in on these properties of that 70-30 split, again, 70% to the LPs, gets paid out on a quarterly basis to our limited partners. So you're the first to get any of the cash flow. So I wanted people to hear this episode so that they're like, how does it actually work? What's an example? How does it function? What potential is in these deals? And, maybe we keep it short, but that's really the long and short of how this functions. So if you're interested, you can definitely reach out to us. Do we have any more that you wanted to go over there? So just to double down on this as we end the episode here, if you're thinking about doing this, you get as a LP, you get the benefits of the cash flow, the depreciation, the refinance, the sale, all the tax benefits, the principal pay down, as you would if you're buying a duplex or a triplex, but you get to do it kind of on your own terms where you don't have to manage the asset. So if you are interested in hearing more about this and you want to, because we don't just invest. We don't just like open up these deals to anybody. That's not how this operates. We mentioned accredited investors before. Basically what a sophisticated investor is, it's just another term. It's like you understand risk. You've invested in the stock market. Maybe you've invested in real estate yourself. You understand how investing works. And we have to create a substantial relationship with you in order to we're vetting the people that we're investing with. So that's part of this. So if you want to get on a list to see deals and have a conversation with us and create that relationship so that we can see if this is a good fit, you can go to our website, juice-enterprises.com/invest. And then there's an orange button there, join our investor list. And you can fill out that form, and that will help you. You'll get updated on things that we're working on, and then we can have a call. We'll set up a call and learn more about your buy box and what you're looking for and to see if it's a good fit. But we wanted to have a short 20, 30-minute episode to break down the syndications that we've done, how it works, the splits, and what you could expect. So we appreciate you tuning in. This has been a lot of fun. Ryan and I love doing these episodes where we talk about what's going on in our portfolio. Just one thing real quick. If you've been listening to the podcast and you like what we're doing here, if you would leave us a review on Apple or Spotify, a 5-star, that would go such a long way for us. We're always trying to continue to bring out more episodes. We went from 1 a week to 2 a week. We upgraded our studio, and we love doing this. And it always, that's the best way that you can help support. So we really appreciate you tuning in, and we'll keep bringing them out.
See you next week.
Before we wrap this show up, I want to leave you with this. If you're listening to the show, chances are you're doing pretty well in your career. You're making maybe 6 figures. You're putting money into your retirement accounts, maybe stacking some cash in a brokerage account, but you're still waiting for that next level. And here's the truth. Waiting just costs you time. Every month you're on the sidelines is another month you could have had a property paying you and another step closer to financial freedom that you didn't take. Ryan and I know this because we stayed on the sidelines too long. We talk about this sometimes. We had the money, but not the guidance. And once we finally got our first property, everything shifted. It was the catalyst that built our entire portfolio and ultimately gave us freedom. And that's exactly why we built the Wealth Juice Inner Circle, to cut out wasted time, just give you the exact blueprint and surround you with a network of people who are closing deals every single week. So if you're tired of waiting and you're ready to finally get your first deal, click the link in the show notes and schedule a call with me. Let's map out your strategy and get you moving before another year slips by.